What's up, outliers? What's up, apes? Happy Saturday. Today, we are on our meme stock watch. So today's focus will be primarily centered around GameStop. But as always, if there's other tickers that are in this world that you want to take a look at, let me know. Always happy to take a look. One of them that I do think is worth us talking about at some point is ONDS. And it's because this company, I actually think, is in the very early stages of likely a fruitful life cycle. This is in the drone space, and we can go through some of their financials and stuff. I wouldn't say that like I'm a fundamental investor, although I absolutely consider it. It's part of what I do. But before we get too far off track, I do want to start with GameStop because there's a couple things that recently came out. First thing is I had somebody asking about some of like the decision making in my positions in GameStop, specifically in the coverage triangle. So I'm going to talk about that, so that folks have an understanding of like what I'm doing and how and why. Again, not suggesting anybody do what I do. I actually would strongly advise against it. I think you should do whatever works for you. But I do try to share information, and then people can choose to do whatever they want, whatever makes sense for you. I am just another random dude on the fucking internet. So I'm not the guy to base what you're doing after, but you can learn different ways and then cobble stuff together that works for you. Okay, so that's one thing. The other thing that we do have to talk about that's actually very cool. I was generally unfamiliar with this guy, Roger James Hamilton. I don't know him, but it looks like he posted something about GNS, which is Genius Group Limited. That's on the New York Stock Exchange, which is an AI-powered Bitcoin education group. And it just filed a class action complaint in the Southern District of New York, alleging Citadel and Virtu engaged in a long-running market manipulation scheme that includes spoofing and naked short selling of the company shares. Here, we'll just read the actual press thing together, because I think that it's certainly worth a conversation around. And I think one of the tricks here is I know that those that are in the GameStop community are like really, really, really hypersensitive to manipulation. A lot of them think like everything is manipulation now, which that's not good either, to be completely frank. But there is something going on, and we can see it. One of the cleanest examples of how I can see it literally in my day-to-day as a trader, it's very simple. It's this. In the options markets, if we have a bid-ask spread, so let's say something is bid at $1, and let's say at that dollar bid, it's 1/100, meaning that there's 100 contracts that are willing to transact at the dollar for the bid. And then let's say that the offer is $1.10. And let's say that this is also 100. This is what's referred to as the size. So this size would be quoted as 100/100. This means that at the bid, there's 100 contracts ready to transact. At the offer, there's 100 contracts ready to transact. Typically speaking, the way that this works is it's a queue system. There is some preferential order routing and treatment, but it's generally speaking a queue system. So what that means is that if there's 3 people that have grossly misshapen heads, apparently, and one that's not connected to their fucking body, don't be these people. But if you are in this cohort, this person would submit their order first. And let's say that they wanted to buy 100. So they should be able to submit their order at the price of 110 at a size of 100 lots, and they should get a fill. Again, this is if they are truly first in line. The order that you're seeing resting there on the market should be available. in another scenario, well, let's continue this scenario. Let's say that this order does go through as it's supposed to. Then typically what happens is we will see this order walk a little bit. So maybe instead of being 110 at 100, the next offering is 111 at 80. Whatever. So then that means that if this person also had an order resting at 110, they won't get a fill. It's below this. Now, again, this is assuming we're not getting fills between the bid and the ask, and we're saying that we're only transacting at the bid or the ask. That's just to prioritize the ordering, because otherwise it gets a little more, well, way more confounding than this. But this is the principle. So this person, if they had an order at 110, they wouldn't get a fill. They would have to up it to 111. And then if they had an order for 100, they also wouldn't get a fill. Now, if they have the election in their brokerage to allow for partials, what that means is they will get 80 of these at 110. This will go away. And then the next liquidity order, I wouldn't say liquidity provider because it could just be other traders, but the next flow of liquidity would pop up here as the next order. And it literally could go back down. It could say, well, now it's going to be 110 at whatever. It could go back down. Okay. This is how the general queuing system is supposed to work. Here's what actually happens literally every single day that I trade. I see this all the time. In this configuration, let's say that I want to sell options. And I notice this very frequently in my earnings plays. Let's say that I want to sell options and I want to sell 50 straddles. And I'm trading something that's not super liquid, so I leg into the straddle. What that means is a straddle is a short put plus a short call. You could put this position on as one position, and you can say that I want to sell to open 50 straddles. If you're in a market that's not liquid, you can't always get a great price doing this, or you can't always get a fill at the size that you want. So very frequently you have to break this up or accept a worse price. If I break this up, what that means is I'm going to sell to open 50 calls, and then I'm going to sell to open 50 puts, just as single orders. It's the same ultimate position that gets entered slightly differently. Well, here's what happens, like really, really frequently. I will go and I will attempt to hit the bid. What that means is I am not bothering attempting to put an order at 106, because when you trade at larger sizes, you already know that's not going to happen. The only thing you do when you put in that order for 106 is you ping these liquidity providers, and now they know that there's fucking demand. So what would they do? Make it more expensive for you if it's a relatively quiet market. So for those that are trading at larger size, going and trying to be cheap can actually be more expensive, because now they know there's demand. They saw the size that you were trying to transact at least for your first tranche. So they'll readjust their books. They don't have to make any sort of fill between these. They don't have to do that. Here's the rub, and here's the fucking problem. Very frequently, as I mentioned, I won't fuck with the mid. I will immediately go to the bid, and I will say, oh, I want to sell to open 50 of whatever the at the money call is, and I will do it at whatever the bid price is. Now, if this is functioning properly, if there's somebody in front of me, that could impact my order. The cool thing is with level 2 data, I can see if this is the case. Level 2 order data lets me see the resting orders in the queue, size and price. I can see both. So I can clearly see if there's shit resting there. and there isn't. So then when I go to place this straddle, starting by legging in, I'll submit this order and nothing will happen. Nothing. And then you say to yourself, well, wait a minute. Why would nothing happen? Because I'm within the price. I'm within the size. That should be a fill. What's actually happening is a smaller element of spoofing. What happens is as soon as this order hits, it's all automated. The system will pull this back before you get a fill. It'll pull it back. And it'll say, oh, no. I didn't want to do that. Psych, just kidding, JK, didn't want to do that. Really, my market is going to be 98 cents by 100. And then you move your order down 2 pennies to try to hit it here. And then all of a sudden, it's fucking gone again. And then you say to yourself, what's going on here? There's a game being played by these institutions. The game is, and this is in an options trading world. In an options trading world, without going too far into detail, we have some key components to an options premium. For the premium of an option, we have stuff like the spot price, strike price, if there's a dividend, if it's a call or a put, and so on and so forth. We have some key inputs that go into this model. One of these key inputs, not days to expiration, but is implied volatility, or really in this case, it's just volatility. It's not implied in this instance, is volatility. Well, when a market is made and you're resting this option here at $1, if I see this option at $1, what can I do? If I am a competitor of whoever is providing that liquidity, and they typically know who's doing what. We don't, just because we're not as close to that as they are. But what could I do? Does anybody have a guess? We already know that there's some key inputs. Based on that order that's resting there, $1 by 100, 110 by 100, what can I do with that information? There's an important term in the options world that you're probably familiar with, which is implied vol. What is implied volatility? Implied volatility is the volatility we imply by extracting it out from the option price. How does this work? I know all of these inputs. I know what spot price is. I know what the strike price is for the option I'm looking at. I know what the dividend is for the underlying. I know if it's a call or put. I know what the days to expiration are. The only thing that I don't outright know, if I were to look at an option, is what's the correct volatility for it? I have no idea. That's where we get into the world of forecasting vol. In this world, we're already playing in a game of fractions of pennies. That's how money is made and maintained. If somebody has a slightly better forecast for volatility, that is a definitive edge over other competitors in that space. Let's tie this together. I just told you that if you give me this information, I can extract what the volatility is that you forecasted for this option. I now know what you think the vol is for this. Then, if I have a better model, I can either decide if I think your vol is wrong, or if my model isn't as good, I now can refine my model and be priced appropriately. This is literally showing information to competitors by offering a market. This is exactly why you see the bullshit that I referred to earlier. Because by showing this dollar by 100, what you're really doing is showing me your forecast of volatility. And it's just sitting there. Everybody can see it. Everybody can derive it. So rather than your forecast being out on display, you put out something that you know is a little bit off, just a little bit off. And there's one of two things you can do. You can either underprice or overprice. That gets into an entire deeper layer of gamesmanship. But that's a big element of what goes on in the options markets. Like I said, I can see it, not just in GameStop. I can literally see it every single day. Where'd my fucking thing go? There. I'm playing with a pen while I sit here and it fell apart and ran away from me. But I literally can see it every single day. Genuinely. This isn't like fear mongering. This isn't tinfoil. Like I can literally see it. I'm actually working with a couple of friends that are working on a case about this, separate from this, because it isn't correct. This is like the same thing that if you went to a store and they have 5 turkeys and the printed price on the turkey is $20, and then you go to pay for your turkey and they're like, damn, this isn't $20, man. Sorry about that. It's 35. 35 for this turkey. So sorry about that. Oh, you wanted 2? There's not really 5. There's only 1. Now that I think of 1, maybe it's a $40 turkey now. Maybe give me a blowjob. I don't know. But this turkey's fucking expensive at this point, I think. Right? That's the point. Is that's the equivalent of what's happening here. And they know it. They know exactly what they're doing. It's all very purposeful. So, a pretty long, small anecdote in preamble into this. Here's the problem with this. Few things. The first thing is we can see how frequently places like Citadel are fined. Actually, let's turn grok on it right now out of, again, curiosity. Let's just eyeball it. I'm going to ask grok how many times in the last year, or let's give it 2 years. How many times in the last 2 years has Citadel Securities been fined? That's funny. The autocomplete on grok, that's the second suggestion. Funny enough, the first one is donated to a charity. And then the third autocomplete is Securities update its app. The second autocomplete is been fined. I'm not the only person looking for this. Let's see what grok says. Now, in the meantime, while that's running, let's see what they're identifying. Engaged in long-running market manipulation scheme that includes spoofing and naked short selling of a company's shares as it relates. So these are two like very different but very big issues. The thing to remember about spoofing is that in general, spoofing really isn't done to fuck you, the retail trader. You're a byproduct. I'm not saying you don't get fucked, but it's not meant to fuck you. It is meant to fuck other people playing the same game as them. So that one's a little bit different. The market, the naked shorting, that's a different bag. That's meant to fuck you, fuck your grandma, fuck everybody. That is literally meant to screw everybody. But the spoofing is there's a drive-by going on. You're not in the gang, but you happen to be walking by, just so that you understand the broader context. It still impacts you, but it's not really directed at you. Zuber says, do you think anything will happen? It feels like the powers that at B will not intervene since these corporations are so massive. I have to agree with you. And moreover than that, I think if anything were to happen, it would be so unbelievably inconsequential to the bottom line P&L that it would do nothing. And that's actually one of the things that I'm waiting for grok to respond here. Okay, here we go. So it looks like it was fined once in the last 2 years, a $1 million penalty for violations related to the consolidated audit trail. Okay, so $1 million. Let's just, again, let's put this in the context. So let's do Citadel. What is Citadel's quarterly net revenue? Let's see. So we know that there's a $1 million fine. Okay. Brock, this is in your wheelhouse. We're not asking anything crazy. Okay, so the most recent available for Q1 is 3.4 billion in net trading revenue. So they made, this is for a quarter. So 3.4 billion. That's where they're at. This is, again, for a quarter. So let's see how bad this percentage is. Let's see how damaging this was to their quarter. That $1 million fine represents 0.03% of their quarterly trading profit. That's the problem. So even if something is done, the penalties are, I'll ask another question to Grok. What was the worst penalty they ever paid? What was the worst financial fine or penalty Citadel has paid? Let's see what the worst is. So the trick here is, why would you even care about staffing the consolidated audit trail? If you're operating a business and this is what you're making in a quarter and this is what the penalty is going to be, this is way cheaper than benefits, salary for however many people you need in order to complete the operation as it's supposed to. So it literally just becomes I can't even call this a minor inconvenience. It's a fucking rounding error. You don't even see this. It's literally a rounding error. So yeah, it's just so far off. Okay, so here we go. The largest penalty Citadel has paid was 97 million with China's securities regulator CSRC in January 2020, resolving allegations of malicious short selling. You don't fucking say. Oh, I love this. Let me see if I can get around that. I want to read this article, but they're too cool for school and have a paywall. I feel like there's got to be like a better series of tools I can get around these fucking things. See if that works. I'm trying to 12-foot IO it. And then I'll grab another article. These guys are, nope, that one's also paid. SEC.gov, here we go. And then Bloomberg. That didn't work. So we can only get it through SEC. And you can see the title there. Just so that you can, again, see the actual source. Resolving allegations of malicious short selling and other trading irregularities during the 2015 Chinese stock market turmoil. These involved high-frequency trading activities by Shanghai unit accused of contributing to market instability. Spoofing is probably in there. For context, this dwarfs other notable U.S. penalties, such as the $22.6 million paid to the SEC in 2017 for misleading clients on trade price and execution. So let's just take a look at these. We know that there's a $22,600,000 penalty. And then there's also, what was it, 96 million? again, let's get some context. This is the worst that they've paid. The worst that they paid was 2.8%. Again, I want to be very, very clear. 2.8%, not of their annual revenue. This is for a quarter. This happens 4 times in a fucking year. Let's see what that comes out to. And then let's see what these are now as a percentage of their annual. Literally all of them are less than a single percent. The highest is less than 0.75%. So this goes back to the original question from Zuber, which is, do we think anything is going to happen? I think something might happen because they've been fined before. They've been actually fined not that irregularly. But we know that whatever happens is not going to be anywhere near damaging enough for them to even give a remote fuck about it. You can combine all of these and they still don't care. It's literally a rounding error. It means nothing. So yeah, boy. Let's continue with the latest. The company believes the lawsuit sets a number of precedents with regards to the protection of shareholder interests as a company. Company is taking action to recover damages caused due to alleged market manipulation. That's awesome. Lawsuit is a class action on behalf of all of its investors who sold Genius Group stock at artificially deflated prices as a result of defendants' alleged abuses. Pursuing class action, facilitate recovery, but for all harmed shareholders. So this, it looks like they're saying that they were targeted for naked short selling, which this leads to kind of an interesting question. Why? And I don't know the answer to this. Maybe you guys know. But genuinely, like, why hasn't GameStop done anything like this? I really don't understand why not. Because like I do think that there's enough of a footprint. Maybe once this is fought and we see how it goes, maybe there will be more. Because maybe it's just a lot of people that are looking at it saying, what the fuck am I going to do here? It's not even going to matter. But, well, let's see what, I'm curious what evidence. I know they're not going to go deep into it because the case is ongoing, but. Spoofing, manipulative, illegal trading practice that involves submitting and then canceling buy or sell orders without any genuine intent to execute them. So, again, the example that I gave you with respect to making markets is like a derivative of spoofing. It's not direct spoofing. This is really meant to ping people's order books and stuff like that. It gives you a description. The purpose of these baiting orders is to mislead other market participants about the level of supply and demand or about the degree of price volatility associated with the security, thereby influence market prices for the security. So it alleges that from 22 to 2025, they entered thousands of spoofing trades designed to create the false impression that there was both excess supply and excess volatility. Company confirmed that the lawsuits seek at least the previously reported no less $250 million in damages. Again, like, let's just run this $250 million in damages. Right? Like, they still don't fucking care. They don't care. That's 1.8% of 1 year's revenue. Even at that number, They don't give a fuck. Like, sure, you don't want a bunch of these. I'm not saying that this is completely negligible and, whatever, you just accumulate these, but that still isn't enough to make that big of a difference. Because here's the other thing that you have to remember from the legal side of stuff. A place like, what is this? Genius Group. I can't imagine that they make a lot of money because it's a penny stock. It's at 86 cents. So I don't know what let's just see out of curiosity. Let's see what their financials are. And these are in what? Millions? Oh yeah, so they're not making a lot of money. It looks like they're still in the process of like building their company, which is fine. But the point that I'm making is that a place like this isn't going to have some sort of massive deep bench of lawyers. Whereas a place like Citadel will have an insanely deep bench of lawyers. Why does that matter? A big part of lawsuits isn't actually winning them. A big part of lawsuits is just slowly grinding down the people on the other side financially. And the thing about somebody like Citadel's lawyers is they will be used to fighting this in-house. They're already on salary. So it's not like you're coming out of pocket additionally compared to what your annual expenses and everything's already budgeted for. That effectively gives you unlimited time and ammunition. For those that don't know, this is a big reason why the US government is so successful when it does decide to go to trial. It's not only you can think, the game's rigged in different ways. I genuinely don't know. So I couldn't weigh in accurately that way. But what I do know is that they have people that are on staff to do that exact job. So they can just slowly erode people because when you hire an attorney, their time is expensive and everything that they file for you is expensive. That's the broader problem here. So let's continue. These orders were calculated to deceive or induce other investors to sell their holdings, artificially deflate prices, and that 98% of all trading days, they repeatedly entered spoofing trades. They repeatedly built massive short positions through off-exchange trading over a few days. So this is using stuff like dark pools. The reason why you do that, again, there's a few different ways that they might do this, but a thing to remember is that off-exchange volume still does hit the consolidated tape. So a lot of times people think that like the order flow that goes through something like dark pools doesn't get integrated into price and stuff. It does. So there's execution incentives and stuff like that, but I don't know why they mention it here in particular, other than maybe they're just like playing in a different spot. Then bombarded the market with spoofing trades, causing significant declines in the price of the stock. Now, another thing to note is smaller companies are highly susceptible to this because, again, think about the damages that they're talking about, $250 million. That gives you a sense of scope. This isn't $250 million over the course of a few months. This is $250 million over the course of 3 years. So what that tells you is that the overall movement in the stock is not that heavy. Let's take a look. Let's go to GNS. And let's just eyeball. So the volume here is 11,185. So we'll call it 11.2. 11,200,000. The stock is 86 cents. So your total dollar volume over the course of a day is $9.6 million, right? It's like really, really cheap. These kinds of names are much easier to manipulate for anybody. So then again, if you put this in the context of Citadel's trading book, the total daily volume, it's just so insignificant. It's not even funny. They could literally mistakenly move the market in there if they wanted to. So yeah, that's entirely plausible and wouldn't even take a lot. The defendants, I think we already read that. Less than a minute after the baiting orders placed, they sold significant volumes of stock short through off-exchange trading. They engaged in short selling, naked short selling, improper short sales. Let me see. Are they hard to borrow? They are hard to borrow. What's their current short float? GNS short float. Let's see. Jesus. I mean, the short float isn't that big. That's weird. That's really weird. And let's take a look at the short interest volume. I mean, that's high. Share availability for shorts is pretty high. FTDs isn't that crazy. It went haywire. Let's see what happened to price in June. Yeah, that's normal during stuff like this. Well, normal in air quotes. You typically see that. And it was super shorted around then. That really is very, very interesting to me because it really isn't that heavy. Of course, in terms of total volume, it's like half. So that part is actually a bit excessive. But this isn't much. The short interest float is not much. Most of it's happening off exchange, which again, that doesn't just happen to manipulate. It does have a passive effect, but that's also just for order execution. I mean, I'm glad they're doing this. And I think the way that this goes at least provides a little bit of a playbook and foundation for others. Zuber said, what do you guys think of this? Like, I'm genuinely curious, like, what's the general opinion of what's being alleged here? I imagine for most of you, this is like another fucking day at the office because I imagine most of you typically feel like this, but I'm curious, like, what are your thoughts here? My instinct is also just like, why this stock? There's not even that much money that they could make in this from shorting, which I just don't totally understand that. But I mean, you also don't make as much money as you do by looking past easy opportunities. So it could be that. Zuber says, if the consequences of breaking the law are insignificant, it won't deter bad actors from repeating breaking the law. Definitely. I completely agree. I think with everything that we looked at, there's effectively no incentive to stop them from breaking the law. This is all completely insignificant. Now, speaking of the recent price behavior in GameStop, we are now at what I consider to be a really, really important level. The reason why I think this is, again, you can see like this was drawn. If you look on the past videos, this line has been drawn for a while. It's not because it's like some magic line, but it's just because this is where I eyeballed prior perceived support. And you can see that it generally held up here. And then realistically, the prior level was here, like the 22 handle. I really did think that this 22 handle was going to be pretty strong. And it proved good here. And it started okay here, but then just flew through here. I think part of that is because of the broader market tailwind, which is struggling right now. But if we zoom out a bit further, you can see that this is kind of like the next major level that we've seen transactions occur, which leads to a fairly monumental time that I wanted to do with you guys, which is draw the next one. We haven't needed to go below this yet. But if I eyeball this and I try to figure out where the next perceived support level is, it immediately looks like something off of these here. But I can also see a really thick volume node here. The problem with this volume node is that we're talking about like years ago. This is using really, really old data. So I wouldn't overemphasize that volume node much at all. But we do need to go out further than 1 year. Let's go to 2 years and let's see. Yeah. So if we look at 2 years, the next primary volume node is here at the 15 handle. So it looks like I would ballpark this, that 1877-ish, as the next price level of interest, which is a bit of a bummer because that gives us a decent amount of downside potential if it does start to break through here, which leads to a quick overview of some of like the rationale and the decision making behind my trades. And if you guys haven't seen, I gave you a video actually because somebody specifically asked for it about like what I'm doing in total. That video I just threw into the chat for you guys, and then I'll also throw it in the video description for those that are watching the recording. But the issue here is the long equity side of the trade is struggling. That being said, one of the coolest things about GameStop is even as this is going on, there's a lot of volatility. So there's still a decent amount of money to be made, and I'll show you how. Brain says GME is within the regression. Other breaks at support have resulted in breach of regression. The problem there, and you have to remember this, is that regression updates, right? Regression is using the current data points that exist. So this will change. It'll also change based on the time frame that we zoom in. So if I look at this regression, this is at like 1929, the lower part. And I'm just going to zoom into 3 months. Let's see where it is now. Well, now it's below it. This is at the 2113. So you see, these are standard deviation channels, by the way. But linear regression channels, which you guys, for those that are familiar with my typical technical analysis approach, I used to use them a lot. I flip-flop between standard deviation and linear regression channels. But linear regression channels are literally meant to fit the data. That's what 150 means. 50 means 50% of the data should be in there. 100 means 100% of the data should be in there. So they move. With respect to standard deviation channels, it gives us a bit of a different lens. And it's also very skewed from this recent behavior. That's why when we zoom in, you actually see it's already below the -1 standard deviation. So yeah, anyways, the main thing there is like, I would mentally bucket those more as like useful just for general context and trend than anything else. There's not like some sort of magical power with regression or standard deviation channels. It just gives you a sense based on the matching time frame that you're using. Where is our current price level? Zuber says 30-day vol looks to have increased recently, perhaps due to earnings. I actually don't think so. I've been seeing it at 70 for a while. Let's take a look quick here. And yeah, I mean, it's been kind of hovering sideways for a while. The last time it had a decent uptick was from here, which was like a month ago. is when we moved from like 50 into the 70s. But otherwise, it's been about what you see, at least for about a month. So I think one of the reasons why you see volatility still remaining slightly elevated is because this decrease. The difference is where vol is now is it's changed a lot. If we take a look at some options and let's go like 30 days out, 34 days out, let's take a look at the out of the money put, which is like a 38 delta. That's at like a 61.5% vol. If I find the same 38 delta-ish, something over here, that's at like 65. So to make these actually like purely same, what I can do is I can take the deltas. So we had like a 38 delta and a 35 delta. And I can literally create a percentage based on their vols. So the 34 delta is at 65.6. So this is 65.6%. And then this one was 61.53 at the 38. 61.5%. And the reason for doing this is it just helps me understand like what's the ratio of deltas to vol. And if we look at this as a ratio, we can see that the calls still have more vol relative. That call skew is really important to monitor because that's like a primary defining feature of GameStop is call skew as compared to put skew, which is what most other options chains have. But if you don't know, this is one of the easiest ways for us to normalize. Reese says, can you elaborate on vol's effect on delta? Yeah, well, well, two things. If you're asking about what's going on here, that's not the same. So there's two pieces. The question you asked, Reese, is still a valid question, but that pertains to how does implied volatility change delta? That's one question. If you're asking about what we did here, this isn't about what implied volatility impact is on delta. This is just normalizing implied volatility against delta. The reason for this, doing this exercise, is there isn't the same delta out of the money call and put. They're at slightly different. So what I'm doing is I'm creating a ratio of the volatility against the delta. So then this is essentially saying like how much vol is there per unit of delta across both of these. So it allows me to directly compare the put delta and vol against the call delta and vol. So then I can easily see for the first strike out of the money what kind of skew exists. Now, with respect to delta, more broadly in the options chain, as volatility goes up, your delta will be sensitive to it. There's actually a Greek that measure this. So if we go to our handy dandy abomination of a deck, that's why in the Greeks video, we go through this actually pretty far in detail. Let me grab, I have like a video that's like everything about the Greeks. Let's see. So this gives you pretty much everything. Here. Wait, there you go. If we go and just poke through, you can see that there's a relationship between things like gamma and vol, which gamma relates to delta. The purpose of understanding these specifically is because delta will still be what delta is, but if things have higher volatility, that's why if we go further and further out in time, you'll actually see your 50 delta option isn't at the money. Let's compare this. So in 16 October, let's go further out just to make the effect more pronounced. Let's go to Jan 27. Jan 27, your 50 delta option is somewhere between 27 and 30, somewhere in there. If instead I take something like GE and I look at where the 50 delta is, you can see that it's a little further out, but as a relative to the price of this, it's not that far out. That's because of volatility. Because remember, volatility scales with time. If something has higher volatility, we expect it to have wider ranges. So if you expect it to have wider ranges, that's going to lift your deltas. You're typically going to see higher deltas because everything now proportionally has a higher probability of finding itself either being challenged temporarily or being in the money at some point. Zuber says, is that because there's more upside potential with the current price point and likely better earnings? It's not actually. That's a great guess though. So the reason why you typically see call skew as compared to put skew in GameStop is actually because of the squeeze potential. It's because it is a meme stock in the sense that it has a lot of people that are highly engaged and interested in this stock. Because of that, it exhibits anomalous behavior compared to other standard names. One of those anomalous behavior pieces is the fact that price can go absolutely haywire if Roaring Kitty comes back. If Roaring Kitty came back and posted a meme, you know for a fact this thing would go haywire. That's just how it is. Because of that potential, that gets priced into the options chain. They're not dumb. They know that that's a thing. With something like this, generally speaking, as you see things also getting closer to a perceived floor, so something that's kind of been beaten down and it's seen as about as low as it's going to go, that's another time that you will see call skew tend to come in when it, generally speaking, isn't expected for it to go down much more at all. But we still see a decent amount of vol in the puts. It's just, you can see where the floor is. If we look at these 34-day options, right? If we go $1 from 20 to 19, we go from a 38 delta to a 29. Then we go another dollar from 18, which is now a 20 delta. We go one more dollar. We cut our deltas in half again. So what this is telling you is that it's really not expecting GameStop to go down here. It's not expecting GameStop, meaning the options market, is not expecting GameStop to go down here to the 17 handle. It has it right now priced as less than 50% chance of hitting the 18 handle. Right now, the general expected range for this thing is like the 19-20 handle to the downside. Then to the upside, if I figure out how far the 50% probability is to the upside, it's here, which is at the 23. So think about that. Right now, the market is pricing in at least the maximum downside potential to be 50-50 at 18. So down 2 points, well, 2.6 points from where we are now. And then to the upside right now, it's pricing it at the 24 handle for it to be less than a 50% chance. So that gives you like 4 points and change. That's the big difference. That's call skew. That's right now the market is favoring potential severity to the upside. The cool part is when we look at the way that I'm trading GameStop, I try to capitalize on that. If we go back to this little log, and again, this is using the sample portfolio, which is a subsection of the broader portfolio, the main thing to note is how much you see in terms of the annualized return on invested capital for these different options at different points in time and durations. The DJ says, I thought delta was the percent chance of it going to that strike. It isn't. That is a okay way to think of it in general. Let's take a look really quick. What you're referring to there is the probability of a touch or probability of in the money, which is really, really important to know. So let's clear all this out and let's learn together really fast. We have delta, which can be an approximation for probability of in the money. It's not perfect, but it's a okay approximation under two conditions. Condition one is we're looking at a low volatility stock, which we know GameStop is not. Condition two is that we are close in time, less than like 60 days to expiration. These two conditions allow you to fairly accurately use delta as a probability of being in the money. And then if you're talking about the probability of a touch, so the probability that a strike price is at some point breached and then either it stays in the money or the underlying reverts back the other way, this is 2 times delta. And I have a video that goes through this way more in depth, so I won't bore you with it here. You can look it up on the channel. It's just like delta is a probability. But the reason why this exists is because, oh shit, what the fuck is this thing? Because there's a relationship between the calculation of delta being a probability of being in the money versus the actual calculation of the probability of an option falling in the money. I actually think that's probably in here somewhere. Let's see really quick. Should be able to look up like what probability? No, it looks like it's not. That looks like that was an older take. Sorry. But the reason why you can use delta as a probability is because the calculation, the actual calculation for an option's probability of falling in the money shares a lot in common with delta, but it's just not a pure overlap. So if I look up delta on the YouTube channel, here we go. Oh yeah, this is an older video. This is from like the middle of last year. Look at that beard. All right, in here somewhere will be, there we go. Let's get the whole thing out there. There you go. You can take a screenshot of that. This gives you a rundown of delta as a probability and how it exists and why. The main thing to note is that when we're calculating delta, delta is ND1. What is ND1? It's this combination, and don't let all, it's just a differential equation. What it's taking is a log normal distribution and it's coming up with relative relationships. So there's a key difference between these. Both of them are scaled by volatility and the square root of time. That's very, very normal. But then there are some very important differences between the denominator, which is why these two are actually different. So here's the video here. And yeah, so feel free to check this out at your leisure. But that's why delta is a probability is a slightly different thing than what you might think otherwise. And I'm literally going to throw that screenshot. Oh shit. I'm going to throw that screenshot in here so that next time somebody has a question about it, we can quickly find it. We need to copy this bad boy. So yeah, a little bit different, not that different, but a little bit different. This gives us delta as a probability and then the relationships between things. There you go. Okay. Great question, though. And then I think I saw another one further up. Jay Williams says, knowing what you know about GameStop in the last year and a half, what low price would make you say, what the fuck? Or would you always be able to explain low price? I guess that part really depends on like what we mean by what the fuck, because I am more of a general market supply and demand trader. So what that means is, like, if I saw GameStop down here at 15, I would be like, that seems really fucking low for what GameStop is. I guess the easiest way to describe that is the point that I would be like, what the fuck, is when GameStop is trading below its intrinsic value. As soon as it's trading below intrinsic value and staying there, that to me doesn't make sense. However, like short of that, it's always just an expression of supply and demand. That's all. What that means is how many people are interested in the stock, not interested in the stock, and why. And then the impact of leverage more broadly laid on top of that. So yeah, I think if I saw GameStop remaining below intrinsic value, that would absolutely cause me some question. Like right now, there's a reason why I still have a decent amount of cash in my position on GameStop. Right now, I'm only using 76% of the total allocation that I gave GameStop. And of that, only 27.5% is actually in stock. What that means is my current position is actually holding light stock. The reason is the stock is going the wrong direction right now. When the stock is moving in this kind of direction, I actually don't want to have a whole bunch of shares. I would prefer to move into shares when either the stock starts to stabilize to the downside or if it starts to rally. Now, I have been slowly nibbling on shares and I will continue to do so. The reason for that is because of that broader call skew that we're referring to. If we just take a look at commensurate options really quick, let's take a look at the 19 December and let's take a look at these. So the 19 put, which is a 29 delta, is at 63.73 vol. And again, you can make your own calculator that I showed you guys here. So that you literally can do this on your own and have an understanding of what you're looking at. The other stuff that I would do here is just include the premium so that you can also look at premium relative to delta. Let's do that. If we look at this 19 strike, so we need to normalize it over the strike as well. So our strike is the 19. Our premium is like 0.8. And then I'll pull the sheet back over so that you guys can see. Delta is 0.29 and my vol is 63.7. The closest call that I can find is actually also a 28 delta, which is great. It's this one right here. It's the 23. So the 23 call trading for 84 cents. Oh, no, I lied. Sorry, the 24. My bad. Sorry, guys. The 24. This is trading for 66 cents. And this is at a 0.28 delta. We can analyze this and figure out how things are being priced. So this is your strike. This is your premium. This is your delta. This is your IV. This is your IV to delta ratio. And then we can have a premium to strike ratio. So in this case, we would just take our premium divided by the strike. This gives us a rough understanding of how much money we make relative. And then we can also have like a premium to delta ratio. The purpose, well, I guess it should be delta to premium. The purpose of this is to figure out how much premium you're getting per delta. And the reason why that helps is because it can help contextualize your risk. So you can literally build your own version of like this little calculator here. That's why I have all these ridiculous Excel sheets built out, is so, again, you guys can hopefully find stuff that's useful to you and make your own versions. So this will be your type, which is whether it's a call or put. And then, yeah. What I can tell is where is the best bang for my buck in terms of if I want to sell puts or buy inventory and sell calls. If I sell puts, I'm effectively selling cash secured puts already. Yet, if we look at where you're getting better vol for your delta, it's actually here in the calls. If we look at how much premium you're getting relative to the strike price, it's here. If you take a look at where you're getting better premium for your delta, it's here. So even though you're getting better premium per your strike, that's because it's a lower price here, right? Like if that's because this is at 24, this is at 19. But let's say that your basis on your shares is 20. Just watch this number alone. It closes that gap. Not enough, but it closes that gap some. So the way that I think about this is by using this information, I can figure out, do I want to buy shares and sell calls against it? Or do I want to just sell puts and collect the money that way? This is in the context of GameStop doing what it's doing now, which is going down. If GameStop stops going down in baselines, then it's a different conversation. Or if it starts actually accelerating to the upside. Right now, as I was explaining, the position itself is actually quite light. And it's literally just because I'm waiting to add more shares. The way that this will work is actually quite simple. You can see that I have two different tranches of puts out. These expire on 19 December. I have a 5 lot at the 22s and then a 6 lot at the 22s. So if I look in the platform, I just have 11 at the 22s, but I track them separately because they're doing different things. One of these was actually rolled, this one. So this one's actually very important for me to track, this position itself. And it's because this position needs to overwhelm this position, and I have to keep that in mind. So if I take this down too fast, I can not do that, and then I'm worse off than where I would want to be. But the most important thing is if we take a look at GameStop's performance on where we started for 2025. Right now, in terms of my performance versus GameStop's performance, I'm outperforming GameStop now by 47% by doing what I'm doing versus just a buy and hold equivalent in GameStop, because GameStop is down like 35% on the year. My position is not only not negative, but it's decently positive for something that's gone down 35%. That's like the most important thing here by far, is by applying a slightly different approach here, I can still maintain exposure to something that has good volatility, but not lose a bunch of money, provided that I manage this as I need to. As you can see, pretty much all of the money that's been made has actually come from the option side of the equation. And it's because of how much volatility is in here. I can make a lot of money. Now, the trick is right now, these 22s are in trouble. So I'm going to have to manage those again. And they still have plenty of theta. They actually have the peak of theta. So I won't do anything with them yet. They're effectively at the money, even though they're a couple strikes in. They're like a 58 delta. So these I wait for now. And I still have a decent amount of extrinsic value that's got to come out. So I have like $1.34 out of this that's going to have to come out, at least if everything stays the same. And with 34 days left to go, I don't really want to roll out to 62. I could come closer to like the 2 Jans or something like that. And there definitely is a roll available here if I need to. But right now, I really don't need to. This one was originally sold for $1.35 and then $1.88. So both of these are underwater, but not overwhelmingly so. The way that I'll manage those is allow more time to pass. And if I can take them down and then roll them out and then down, ideally out of the money, I will. Or for example, this is what that would look like for those wondering. And as always, like if you have questions about what I'm saying, if what I'm saying doesn't make sense or anything like that, like seriously, please ask me. That's why I do these on a live stream, is so that I can hopefully give you information in a way that you can connect with. And on a live stream, you can walk me onto target. If I close these down for what they're currently trading at, which I already forgot what that is, 236. So let's pretend we close both of these for $2.36. That means our net loss is going to be, we're going to lose $7.93. We could literally just take that loss and we will still be net positive on our options component to this, even the short put component to this. That's entirely a choice, and sometimes it's not a bad one. Because I don't necessarily expect there to be a profound amount of additional downside in GameStop, I don't really care that much. So now what I can look at is, well, what would I roll these to? So let's just eyeball it. Right now, the stock is at 2066. And we can look at a couple different expirations, but I'll go out to the 16 Jan. And let's say that we wanted to try to get out of the money. So we go to the 20s, which we're going to get $1.64. So at the 20, those are a 39 delta, and we're going to get $1.60. I can now figure out how many of these I need to sell. And you can see something right out of the gate. Notice what I just did. I put on the same position size, 11 contracts, and the position size here nets out profitable. However, remember, I have this rolled position that I have to contest with. So realistically, I wouldn't make 967. I would still be positive, but only $32, which isn't bad. But my preference here would actually probably be to offer a little bit less. Give it 10. On these, it will net me slightly negative at 128, but I just freed up another 100 shares. And then what I can do with that is actually buy outright to increase the stock position. So then let's just say those came down. And right now I'm only using 67.4%. So then let's say that I choose to buy some more. Today's 15 Nov. Let's say that it's trading at $20.66. And let's just take a look at a couple transactions. Let's say if I get 200 of those, that takes me back up to 75. That brings my basis down trivially, down to 22, not much. But it does take my basis down a little bit, and it gives me 800 shares. So now I can sell more of these. Let's say that I'm at the 24. I wouldn't want to be too far under the 24. I would either do it at, well, my basis is 22, not 24. So my basis is here, which is a 47 delta. I wouldn't want to do anything there. I would be here at like the 24. So I can add another like 2 of those for $1.21. So 121, we get 2 of those. That's going to be at the 24 again. Now you can see that we're actually building profit on just holding these shares that otherwise are underwater, but I'm also coming up with the slack for this position. Because remember, we were net loss a little over $100. This compensates for that. And I reconfigure the position a little bit more. Josh says, if when rolling covered calls, my strike price is passed, what is the best way to manage the position to hold on to the shares? Do you keep rolling and collecting premium until you get assigned or roll up? That is a really, really good question. And the reality is it depends on when, well, it really depends on what you're trying to do with your inventory. What I mean by that is if you don't want your shares to get called away, the first thing is genuinely don't sell covered calls against them. And it's because your short calls can be assigned early. They can be assigned for no reason. Somebody could literally just click the button. It's super unlikely. But again, this is why you have to weigh it against what are you really trying to do with the shares. So if you were like, I would rather die than get rid of these shares, like I know some apes are, which is completely fine, don't sell calls against them. Because there is a small but present probability of them being called away for some illogical reason. That can happen. Now, that part aside, if your position is, I really don't want to lose the shares. If I did, I wouldn't like it, but I would still not die. I would be okay. That's a different scenario. Then you can sell calls against them. And the way that I think about selling calls against them is I first protect myself by making sure it's at a ratio. So notice how I have 6 calls here against 800 long shares. So I have 200 shares that are not covered by any calls whatsoever. That's schmuck insurance. That's in case this thing decides to go parabolic haywire while I have these short calls. And let's say it goes into a short squeeze. It's going to be next to impossible for me to get out of these calls. And there's a really good chance that they're going to get assigned early by people trying to cover their positions. Okay, that means I'm going to lose 600 of this 800. Don't want to, but it'll be okay. I still have 200 shares that I can attempt to participate in the parabolic up move until I can just rebuild my inventory. A big difference between the way that I trade and a lot of apes trade, GameStop specifically, is when we go through these big price fluctuations, I trade. So what that means is when like this squeeze here, I had both long calls and shares. I phased out of both of them as we were up, not at the peak of like 80 and change, but I started exiting the position all through here. And again, the reason for that is if I buy 500 shares when it's at 15, again, let's just do an example together. If I buy 500 shares when it's 15, that means that I have spent a total of $7,500. Now, let's say that I sell 500 shares when it's at 60. That means I just made 30 grand. So what's my total profit on the position? It's $22,500. What does that equal in terms of a percentage? Tripled the money. Why do I care about this? Well, it's because now when GameStop, let's say GameStop does go back down to 15, let's just say it went back down there. The difference is now, rather than being able to get the 500 shares, now I can get 2,000 shares. I can accumulate way more inventory here. So that's the reason why I don't just buy and hold through stuff like this. I actively trade it. And it's because I'm really trying to maximize the total amount of profit that I can take out of the trade itself, so that when things do settle back down, I now don't have the capital for 500 shares. I have the capital for 1,500 additional shares to do stuff with. So anyways, going back to the short call equation, just remember, I would do it at a ratio. I would make sure that I don't sell calls if I'm not, again, you don't have to be happy about it, but if I'm not otherwise okay with the potential of my shares being called away. And then the way you can manage them is you just have to make sure that there's extrinsic value that remains in the option. Your options, your short calls become really high risk of early assignment if there's not a lot of extrinsic value. And specifically in dividend paying stocks, if there's a dividend coming up that exceeds the remaining extrinsic value. All that means is, because remember, let's take a look at a scenario really fast. Let's say that somebody sold me these, let's do in the money. It'll be a better example. Let's do these. Let's say one of you sold the 19 calls and you sold them to me for 305. Let me grab my little pad. So you sold these to me for 305. So I have the 19 calls for 305. Okay. Now, if I choose to exercise my option, that means I get to buy to open. Let's just do a one lot. So I get 100 shares at $19. What am I giving up? I'm giving up the remaining value of the option. So in this case, the option is worth $3.05, but some of that is intrinsic value. We can calculate our intrinsic value by taking the difference between our strike price and spot price. This is why, going back to a longer term example from a while ago, this is why Roaring Kitty didn't exercise his options, is because he literally would have lit tens of $millions of money on fire. He would have just lit it on fire, which wouldn't make any sense at all. So here you have $1.66. So what we do is we can figure out how much of our premium is intrinsic versus extrinsic value. So we know that this is intrinsic value. This is how far in the money it is. The next part of the equation is how much of that is extrinsic value. So it's literally the difference between these two numbers. If I choose to exercise, I give away my extrinsic value. It's just gone. Whereas if instead I wanted to get out of the short calls, or if I wanted to monetize the position, I would just sell it. Again, remember, I originally bought this option, but I would just sell it. Because if I sell it, I get both the intrinsic and extrinsic value. I get this total value. Whereas if I exercise it, I only capture this value. I don't get the total value. So that's why early exercise is so rare, because it just financially rarely makes sense. The way that you can avoid that is, as you described, as the underlying is moving, and let's say it continues to accelerate to the upside, all I would do is try to roll out and up, out and up, out and up. So what that means is, if let's say instead I sold these 19s, or let's go closer in time so that we can visualize a roll. Let's say that I sold these 20s, but I don't actually want to lose the shares. What I would do is I would say, okay, I can buy this back for $2, $2. I buy these for $2. If I roll these out to something like this, the 22 strike or the 23 strike, what I've done is I've increased my upside, my basis to the upside. So rather than selling my shares at 20, now if I was forced to sell my shares, I would sell them at 23. So it's $300 per one lot that gets unlocked. And by repeating this, by balancing how far out in time you're going and stock movement, you can wiggle yourself out of a lot of nasty positions. So that's what I do when the short call becomes swallowed. Zuber says, why not roll the in the money puts like 23? You could get positive again, and the implied move looks like 4-8. It's because I'm not worried about getting positive on the puts. If I roll to something that's in the money, now I have another problem. Unless it rallies up until that point, I'm fucked. I now have something that's fairly deep in the money that's going to get deeper in the money. It's going to collect less total value as we get closer in time because there's going to be less extrinsic value remaining for me to collect. And then if I choose to attempt to manage it by rolling, as you go further and further in the money, your rolling choices really get constrained very quickly. So that's why I wouldn't roll to in the money. Joshua says, when rolling, is that call credit spreads? When rolling call credit spreads that are underwater, is there a mathematical equation involving theta to determine the best time to roll is? No, there isn't again, it's because when you think about what that means, what best is, could you define what best is? Best could mean I want to increase the total profitability of the position. Or best could mean I want to collect as much theta as I can. Best could mean I want to do my best to reduce the probability of my option getting exercised. My point there is all versions of best in all of those lead to different management decisions. So the way that I would navigate that is actually really simple. I would just throw away the idea of like what's totality best. And I would just think of it in terms of like what's best for my current position and what I'm trying to accomplish. And then I would optimize off of that. Nathan says, I'm a bit confused on how you adjust the basis down. And is the goal to not get assigned when selling cash secured put? Would we roll the cash secured put if market falls? Good question. The way that the basis is adjusted on the cash secured put is through the rolling activity. In this scenario that we just eyeballed, we were taking, what was it? Our strike price was 23 or 22, and we took it down to 20. The way that we do that is we sacrifice some of the premium that we otherwise would collect, and instead we're prioritizing a basis adjustment. Now, in this scenario, whether or not you want to get assigned really is entirely up to the trader and what your preference is, what your inventory preference is. So for example, if I were to buy, or let's say that I wanted to buy 100 shares of GameStop and I want to buy them at 2066. A lot of times what I do in instances like this is actually come really close in time and sell something that's in the money. I collect the premium, the extrinsic value, and then I have a really high probability of being assigned. That's a way to make a few bucks to get assigned. Now, there's a problem with that, which is there are plenty of instances where it rallies and then you actually didn't get in at the price that you want. So I really only do that if I'm like 50-50 on taking on inventory. If I'm like, yeah, I wouldn't mind it, but I'm not necessarily going for it. Otherwise, I just buy. In general, the purpose of the short puts, for me at least, is to collect the premium. It can, and a big management decision is being able to take assignment if you have to. But for me, I typically don't. So yeah, if the market falls, my typical preference is to roll. That's actually what you see me doing already, because you can see that my prior option here is a 25. And then the current position that's on in GameStop, I'm at the 22s. So what I've done is I've already taken myself from the 25 strike down to the 22s. I've already decreased my total basis by 10% plus, 15% really, which is exactly why I do that. So yeah, normally I favor the basis adjustment, and it's because I think of it this way. If I get assigned at 25 and I want to sell calls against my shares at 25, how much premium do I get? Here I get like 53 cents. Not bad, but it's not really what I want, because if I get assigned, let's say at 22, I make double that. So I typically try to get basis adjustment over anything else. And it's because when I eventually choose to be assigned, then I position myself so that I can actually sell calls and make like a decent amount of money. Joshua says, I meant covered calls. In this situation, rolling covered calls, I want to make the most of premium when rolling. Got it. Yeah. So then you would optimize for how much premium you get. The problem that typically leads to for people is you don't actually make that much in premium from rolling decisions, especially as you go further and further out in time. So yeah, I wouldn't really, it's not the way that I typically do it. I would typically try to get out of the in the money stuff and then just open up a new one at the spot that I want. But yeah, you could definitely optimize for whichever way you want. Zuber says, if you had 100K and a goal of getting 50% return on investment in 6 months, how would you best achieve this by trading vol and GME? I don't think it's there. I don't think you're going to get 50% in 6 months based on the current vol and GME, unfortunately. The best way to have a shot at doing something like that with like a reasonable probability of success is if there's a directional play. But with volatility, unless you leverage massively, and if you leverage massively, then obviously the risk of completely blowing up is there. So yeah, that's with volatility as it is right now. I don't think that there's like a direct path to that I would take personally. No one says, is there ever a time you would choose to use short spreads or just shorting a call put? In what context? Do you mean in terms of my GameStop position, or do you mean in terms of like trading options in general? Because they're very different things. The way that I trade options is based on what I call profit mechanisms, which are like specific market effects that I'm trying to capture. And GameStop actually is its own profit mechanism for me because of many of the unique qualities it has. So with something like vertical spreads, for example, when we're talking short spreads, like I wouldn't bother with anything like that in GameStop. But there are other strategies that sometimes do call for things like vertical spreads. They're just rare. I don't really use them that much. And it's because in general, I don't prefer them. They give you the worst of like multiple worlds. So I typically avoid stuff like verticals. Another good question though. Awesome. Super sweet hanging out with you guys. It is time for me to bounce, go grab some dinner. I will see you guys on the stream next Saturday. We do these every single Saturday. And then for those that are in the Patreon, tomorrow we have market prep to get ready for the week ahead. And then as always, my Sunday video drop will be out tomorrow as well. In the newsletter, ton of stuff happening tomorrow. Be an outlier. See you guys later.